This short video on the second quarter of 2024. So, as you probably already know, this has been a very strong start for the year. So, you can see that this page in particular shows just the second quarter of 2024. You can see that the US stock market, strong gains of about a 3.25%. International, however, was a negative 0.6%. So this has been a common theme. I've been talking about it for probably 12 years now. I have not been a fan of international stocks for a decade or more. I think there are some fundamental weaknesses and challenges that countries outside of the US have, in particular in Europe. And as we've seen, this has played out over the past decade or so. The US stock market has absolutely outperformed international in almost every single year over the past, again, 10 to 12 years. And so the big question is, will that continue? Obviously, I don't have a crystal ball, but I don't think anything has fundamentally changed in the European markets for me to suddenly change my mind and think that suddenly international is going to start outperforming US stocks. Again, I think they have some challenges there, and I don't see them getting any better. So that is why we have been overweight to US stocks, and at least for the foreseeable future, will continue to be. You can see emerging market stocks really had a nice 3 months, up 5%, outperforming the US stock market. Um, Emerging markets are basically countries that are not quite developed yet. So think in terms of Vietnam, think in terms of India, China, South American countries, a lot of Asian countries. So these are emerging markets. And although the last 3 months have been quite positive, these countries and the markets have struggled really for many years, and so that's why we don't have very much of an exposure to emerging markets. You can see real estate, global real estate down about 1.5%. U.S. real estate was basically flat for the last 3 months, however. And you can also see U.S. bonds produced a very small positive return. Um, Bonds have certainly struggled over the last few years, so it's nice to see some green and some positive returns there. So this next slide, again, if you've watched any of these videos, you'll know that it's one of my favorites. It gets updated every 3 months, and this just basically shows um, from June, from the last 12 months to this June. And over the last year, this is the performance of the markets as measured by the MSCI All Country World Index. But what's important here are these headlines. And the idea is that often we'll see a very negative headline, something very negative in the news happens, whether it's something in Ukraine or Israel or something about the economy struggling. And you'll see that in real time when we read these headlines, we often think that the market's going to react, that the economy is going to suffer as a result. And sometimes that is the case. But more times than not, you'll see a negative headline and then the market continues its forward movement. And this is just to show that we can't rely on headlines because the headlines cause you to want to do something and react because it's very emotional when you see something and you read about something and it seems very negative, and all you can think about is, how is this going to affect my portfolio? What's this going to do to my retirement nest egg? And that's usually the worst thing that you can do, is to react emotionally based on some headline that you read. And so this is why I suggest try not to get so caught up into the headlines, and certainly B, if you do, to try not to react to that. And I'm fortunate in that I had many of you as clients for years now, and you've seen the markets and what they've done, and you've also lived through some bear markets, and you know that reacting is usually the worst thing that you can do. Um, this is a deeper dive into just US stocks for the second quarter. And what you can see here is that there are different types of US stocks. There are large cap growth, there are large cap value, there's even smaller companies that we can look at and look at the performance. So when you look at, well, how did US stocks do? Well, you really have to look at the different uh, characteristics of US stocks. You can see that large cap growth, so these are large growth oriented companies, over 8% return in the last 3 months. Now compare that to small cap value, negative, almost 4% return. This is an almost 12% difference between large growth and small value. And so this is why when we manage portfolios, we are not just looking at US stocks as a whole, but we definitely try to make the portfolios as such where we're taking advantage as much as possible the different aspects of US stocks. So in this case, large cap growth outperformed by a very wide margin all types of small companies, and then even large cap value. So these large cap value had a negative 2% versus large cap growth that had a positive 8%. Again, 10% difference. These are the types of choices when you're building a portfolio that can make a big difference, not just in a 3 month period, but over a year or certainly over several year period. I really like this slide because what it shows is over the last 50 years, this is what the market's done. And you can see that when you broaden your time horizon, that these dips that we experience, look at this Black Monday crash. At the time, it was unprecedented in the scale of the decline. And when you stretch the time horizon out, it becomes just a blip. And that's really the thing to take away from this is that day to day, month to month, or even year to year, we will experience declines. They are inevitable. We see them time and time again. But when you broaden your time horizon, then all of a sudden, those what feel like insurmountable large losses that can occur on a bigger scale, they look temporary and they look small in comparison to the overall gain. So I think it was Warren Buffett who said it's not trying to time the market, but it is time in the market that makes all of the difference. And you can see here, I'm not a fan of trying to time the market because what you'll see is these red dots represent the loss at some point during each of these years. And you'll see that often in many years, there is a negative return that happened at some point during the year. But you'll also notice that the market closed higher in most of these years. There were exceptions here. There's 3 years here, this year, and this year. In those years, the markets produced a negative return. But if you look at all of the other years, not only did they produce a positive return, but at some point during the year, it was negative. So look at 2020. Again, going back to COVID, this was March of 2020. The S&P dropped 34% for the year. It was a negative 34% just a couple of months into the year because of all of the uncertainty with COVID. But you can see what happened after the end of March. The market started going up, so much so that the S&P actually finished up a positive 18% for the year. That's a nearly 50% move in 1 year. This is why we don't try to get out in order to get back in, because we'll often miss a lot of the gains if we try to do that. You can see here that this is the number of 5% pullbacks per year that we experienced. And so far this year, we've only had one. Last year, we only had three. The median is about 5 or so. On average, we usually have at least 5 times a year a pullback of 5% or more in the S&P 500. The last couple of years, so far, it's been below the average, which means that the markets have been more stable. Now look at the previous year. This is 2022. 12 pullbacks, very, very volatile. And you can see that sometimes we'll have very few and sometimes we'll have several in a year. And this is probably one of the most important slides that you'll see. What this shows you is this light blue area here. This represents the earnings of the S&P 500 companies. And this darker blue line that you see, that I'm tracing here, this represents the S&P 500 performance. And what drives long-term performance of the markets more than anything else are earnings. How much money are companies earning? If earnings are going up, usually the S&P 500 will also go up. Sometimes it's not one-to-one, sometimes there's a lag, but one of two things usually happens. And if you remember a video from probably about a year and a half ago, I talked about this divergence. So we were here. This is where the S&P 500 was, and the earnings were here. What you'll often see is that earnings go up, the market goes up. As earnings come down, the market goes down. As earnings go up, the market goes up. Earnings go down, market goes down. Earnings go up, market goes up. But what did we see here? We saw that the earnings were going up, but the market was going down. That doesn't happen very often. And one of three things will happen in that situation. Either earnings will come down to meet the market will come up to meet earnings, or both. Earnings will come down a little, market will come up a little, and they'll meet in the middle. What did we see here? The market went up to meet earnings. That is a very positive situation because we want earnings to go up. That means that it's a very strong economy. Companies are making money. And as a result, the price, what the stock market does, what the S&P 500 does in response to that, we want to see as earnings go up, the market goes up. And that's exactly what we saw here. So now there is a much smaller gap between where the S&P 500 price is and where earnings are. If earnings continue to go up, we would expect over a period of time that the S&P 500 will also go up. That's really what drives the market longer term. The other thing that's driven the market over the last couple of years are interest rates. So for years, we saw interest rates very, very low. They spiked back in 2018, but only briefly, and then they came back down. Then we had COVID, and we had even lower interest rates for a long period of time. These low interest rates, along with supply issues, created inflation. And you can see that inflation and interest rates spiked. That's what we're all dealing with now. Fortunately, they appear to be coming back down. As interest rates go up, bonds don't do as well and they go down. As interest rates come down, bonds prices go up. So it's an inverse relationship between interest rates and the price of bonds. And so that's why we're starting to see some positive gains in bonds because interest rates have been coming down. So this is a slide I in almost every video show you because it's very, very important. What you can see here is the market going back to 1970 to today. What you'll also see are these gray bars here, 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 and here. Those gray bars represent recessions. And how wide they are means it's a longer recession than a very narrow bar. But these are each recessions. And what we can also see are these gray areas here. These are leading economic indicators. When these are positive, it means that the economic indicators are pointing to strong economy. Once they go into this orange-ish color, that's when leading economic indicators are suggesting that the economy is slowing. And what you'll also notice is that almost universally, every time we see the leading economic indicators turn negative, we get a recession. They turned negative here, we got a recession. They turned slightly negative right there, we got a recession. They turned negative here, we got a recession. They turned negative here, we got a recession. They turned negative here, we got a recession. Turned negative here, we got the COVID recession. And look at where we are now. Leading economic indicators have turned quite negative, negative 5.3%. So you could look at this and think to yourself, well, we're almost guaranteed to have a recession. And certainly that is what some analysts expect. They think that we will go into a recession at some point. Another take with this data is that this is exactly what the Federal Reserve has orchestrated. This is not a byproduct of interest rates. This is what they intended to happen by increasing interest rates. This is what they wanted to see. They wanted to see economic activity start to slow, unemployment go up a little bit, because they are trying to fight inflation. And this is how you do it. And so far, they have been, I would say, pretty successful in fighting inflation. It's still high, but it has come down from the highs. It is starting to head lower, which is exactly what they want. So will we see a recession? It's entirely possible. So far, there are still very strong signs in the economy. And those strong signs are earnings that we just talked about. Those are still positive. They're looking healthy. Unemployment still, although it's going up, it's still quite low historically. And so we can also expect at some point the Fed to start cutting interest rates. And as soon as they start doing that, I would expect these leading economic indicators to reverse course and start to go up. When will they cut? Your guess is as good as mine. But I think there is a good chance that we might see an interest rate cut at some point this year. Some people are calling for multiple rate cuts this year, only because of this. This has turned quite negative, and the Fed doesn't want to be behind the eight ball again, meaning they don't want to wait until the market, the economy slows so much that now they're cutting rates, but by that point it's too late and we have a recession. Their goal is to try to avoid a recession and at the same time make sure that inflation comes down. It's a tough act. It's hard to walk that line, but that's what they've been doing, and I would say they've done a good job of it so far. You can see unemployment. That's one of the key areas that they look at. Obviously, it spiked during COVID, and then it came back down to really low levels. And what we're starting to see here is an uptick in unemployment, which again is quite positive in that that's exactly what the Fed is trying to orchestrate by having high interest rates. You can see Consumer Price Index. This is the CPI, which is basically inflation. You can see it spiked and it has come down dramatically. That is a very positive sign for the markets. So, if you have any questions about the markets, about your portfolio, your allocation, about leading economic indicators, you name it, please let me know. We'll schedule a time. I'd love to go through it with you. Until then, I hope you have a wonderful rest of your summer.